The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome back to another edition of the Daily Dots. Chase flying solo with you here on Thursday, September 25th. And the market has been allowed to go down yet again. S&P closed down 0.5, Qs down 0.43, small caps down just under 1%. Equal weight S&P down 0.82, and worth noting on equal weight S&P, you can draw a pretty clean uptrend line that goes back to, let's see, May, actually. That just broke today. You're still above the 50-day moving average, so it's not like you're, getting smashed or something, or you're at some bad level. It's not some giant drawdown, but still, you're kind of losing some momentum there. You're downshifted from a pretty healthy uptrend that has, been defended multiple times, and now you're below it. So that's something I've been kind of watching for of late, and that's happening. Obviously, cap weighted can, stay a little higher. It has the same trend line, but it's still above it. Same for NASDAQ 100, same trend line that goes back to May, but you're still above it. But equal weight, notably, now below that trend line, and Mag 7 way above it still. So something I thought was worth noting. And then even on Tesla today, now you have to go like a 4-hour, and just the last few days, Tesla went literally straight up, and then you build this 45-degree angle for a few days. That's one of my favorite chart patterns to look for something to short, is something that goes straight up, that does a 45-degree angle, and then breaks below that. Just offers a decent risk-reward place to essentially put a stop. Not, any sort of recommendation or advice at all, but for the technical analysts out there, so it's a way to think about trying to find, something that snaps its really strong momentum. All world ex-US, worse than the S&P, down 0.61. And that's because the dollar was very strong. Again, we talked about it yesterday, up like 0.6, 0.7, same thing today. You finished up 0.62. And speaking of trend lines, you can find ones about 2 months long on the DXY, and you closed above that today. We're at 98.45. That doesn't sound that crazy, but you were at 96.25 back on the day they did the interest rate cut. So we're significantly higher than we were then, and there's so many shorts out there. If this keeps going too much, you start to see a lot of people have to kind of cry uncle and squeeze. Bitcoin was down 3.67, pretty ugly for Bitcoin. And speaking of breaking trend lines, you have the essentially same trend line as I'm talking about on everything else. Goes back technically to late April, maybe early May for Bitcoin. Same thing, you broke it today. So you're starting to see, or at least I'm starting to see, kind of a piling up of things losing their speed, being in fifth gear, and kind of at least downshifting to fourth or third. And I'll have a little bit more to say on that here in a minute, but up a little bit on oil, 0.3, nat gas up over 2%. Gold was up 0.3. Given the dollar move and the rates move, I'll mention here in a second, and the Bitcoin move, I think that's pretty solid day for gold. Even gold miners up over 1%. Silver up 2.8. You're at 45 and change now in silver. Another really strong day for platinum, up almost 4%. Palladium up almost 3%. So PGMs continue to perform. Maybe the most notable single thing from the day, for me at least, was 2-year yields up 6 basis points. That's a substantial move, and we'll talk about why, because it's kind of a data-driven thing. With that said, the 10 was up 3 basis points, and the 30 was essentially flat. So no follow through from the 30, which is interesting to me. As far as Mag 7 went, you had Google down a little, Microsoft down a little, Nvidia up a little. Let's see. Amazon down about 1%, Meta down about 1.5%. Tesla was down 4 and change, and mentioned before, kind of broke a very short term, very sharp, straight up kind of trend line. Uh, vol was up about 1.5 today, so nothing big, but it continues to inch higher, I think you could call it. Chinese tech stocks up a little over one. Chinese stocks, there's just regular large caps up about 0.25, so not a big move there. Although on a day where the U.S. market's down 0.5%, anything that's up is really helpful. To turn to data real quick, we had, first of all, just a ton of data today. Not all of it, exactly tier one, but tons and tons of data. The Bureau of Economic Analysis did their kind of like annual update. So we had the second quarter GDP relook, and same with consumption, GDP prices, core PCE prices. They took a look at all that, and all the revisions were stronger essentially. And these actually, my Bloomberg screen here is like focused on the second quarter, but they actually go way back and look at a bunch of other stuff. And what you essentially did was you brought up growth and you brought up inflation both. And the inflation was like, hey, it was higher than we thought for like 2 years, especially last year. But even in the last in that second quarter, they pulled it up from 2.5 to 2.6. That I think that's why you have the 2-year yield up, 6 basis points, is you had growth and inflation have been trending higher than we thought. So naturally, your big bears heavily focused on these jobs revisions that were worse than expected. Now all of a sudden we look back and like, yeah, well, growth and inflation though are better than we thought. So that kind of makes the picture for the Fed a little bit less clear. Maybe not, immensely so, but the big worry that the Fed has right now is obviously the labor market. We had jobless claims today. Initial jobless claims were the lowest in months. You were expected to be 233,000, and you printed 218. So the 4-week average is now back to falling down. Continuing claims were also lower than last month, lower than expectations, and actually starting to bona fide trend lower after having been trending higher for over a year. Existing home sales were a little bit better than expected. You had the Kansas City Fed's manufacturing survey better than expected. So you just had data print after data print after data print better than expected. And I talked about this yesterday. Like, I'm 50-50 on whether or not we're late cycle and possibly teasing a recession next year, or we're early cycle and we grow better than everyone expects and the Fed looks dumb for having talked about cutting rates. Or not talk about having cut rates going into next year. We'll see. I'm genuinely 50-50. But a day like today, all this data said, yeah, your early cycle, you're actually picking back up and doing okay. Other than data, some news out today. Well, first I'll talk about the neutral gamma thing. I talked about this a little bit yesterday. We came into today positive gamma, which, just for a refresher, like, forget what it means. Like, what it means for the market is if you're positive gamma, you're probably gonna have less volatility, because options dealers, they do the opposite of what the market does to keep their books squared away, keep their risk where it needs to be. When they get into negative gamma, they do the opposite. So if the market goes up, they buy. If the market goes down, they sell. So it amplifies whatever the market move is, all else being equal. And that can push volatility higher because the moves just get bigger. You get used to every day the S&P is up or down like 0.2, 0.3, 0.4, 0.5. There's just no realized volatility. And that's where we've been for months now, just no realized volatility. But all of a sudden they get stuck in negative gamma and the market's down 1%. Well, then those options dealers have to sell to kind of get back squared away. Is a simplified way of thinking about it. Sometimes that doesn't matter much, and sometimes it does. The times, in my opinion, when it matters a lot is when the systematic investment strategies out there, whenever they are just chock full, they've just bought all they can basically handle, and they would have to sell on any wobble. Then it gets really important. That's where we are. This is what happened last July, and we had a pretty nice little sell-off. And this is what happened also in April with the tariff-induced sell-off. Obviously, the tariffs are what sparked that fire, but what made that fire burn really bright and really quickly and really big was the fact that you got into negative gamma, and you had CTAs, vol control cell, or vol targeting funds, like all this kind of stuff was all very, very, very long, and then they had to sell a bunch. And it's not like a choice. It's like you've built rules, and those rules trigger, and you do what you do. Or we're there. Like vol control is at a multi-year high for their positioning. You know, realize vol's been so low. I have no doubt that all the pod shops and everyone that uses vol targeting, lower volatility gets, the bigger position size can be, have really pushed themselves high. And then if you get into the situation where you get into positive gamma, you get a 1% down day, a 1.5%, 2% down day, whatever, and that vol really expands open, then they have to sell. And that makes vol go up, and that makes more people sell, and that makes vol go up. And then you just get like a burst of action and volatility in the market that has really nothing to do with the economy or the fundamentals or earnings. It's very mechanical. That's why we watch for this stuff, is because sometimes things can happen in the market don't really make sense. It's this stuff sometimes. Now I've been warning about it and cautious and concerned about this for probably 2 months now. And multiple times we've gotten close to like lighting this fuse, and we just didn't. And we've got a lot in that couple months, so being cautious wasn't necessarily good. But we're right back there. And like I said, equal weight kind of breaking trend, Bitcoin breaking trend. So you start to see that softening up where this could happen. Now, you could be up 1% tomorrow or up 0.5% the next 3 days, and it's all over. Nothing bad happened, and I'm just concerned about this yet again for no reason. But we are kind of on the precipice of, if you have a 1% down day, I would suggest vol control is going to be selling, no doubt about that, and tens of billions of dollars. CTAs, the drawdown would be big enough where they would probably have to get out of equities. The vol targeting guys would have to reduce exposure. Your average just hedge fund out there that does their position sizing based on some sort of vol metric is going to have to bring down their positioning. So virtually everyone's just kind of selling.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Another thing to add into that, we talked about, the net equity supply being close to going negative. Like, we've had a lot of IPOs lately. So you've sucked up a lot of liquidity with all these new IPOs and stuff. So not to mention people selling shares, established companies. So the equity issuance of the last couple of months, pretty substantial, not to mention the debt issuance. So like capital's finding a home. So, just think of it in pure math terms. There's just less capital than there was a month or two ago to find its way newly into equity. So, and there's a ton of capital that can find its way out, like I just outlined. So the conditions are there. They do not have to be met, but the conditions are there to have this sell-off turn into more. And that, my guess, is kind of 7 to 15% drawdown to kind of burn all that away. And then you're left at the end of that with who knows, right? You just got to figure it out, put the pieces of the puzzle together whenever you hit that kind of 10-ish% to see, like, all right, is anything real like going on here, or was that just a positioning rinse? If you're confident it's a positioning rinse, that's when you can kind of get aggressive and buy things on their dips, which is super useful. But the only way to be able to buy a dip is to kind of get out of the way just enough, raise a little cash, hedges, whatever, so that you can flip those hedges or that cash back into buying the dip. But not every dip should be bought, but probably this one will be worth buying. We'll see. One of the things I want to talk about is NATO and Russia. Apparently there was a meeting in Russia with a few different NATO leaders, NATO countries, basically where the NATO folks said, look, we're going to start shooting your stuff down if you keep flying into NATO airspace. I found it interesting because Russia is both denying it, but also said, like, well, that was a response to Ukraine going after Crimea the way they are. So they're kind of denying it, kind of not. But it sounds like NATO was very, very clear with Russia, like, yep, stop, that's enough. We're going to start shooting stuff. So it'll be interesting to see, like I've talked about before, like if it's over, if they chill out, they got caught with their hand in the cookie jar, and now they're being threatened. What do they do? Do they press that and see, will you really shoot us down, or will they kind of leave it alone for the next year? We'll find out. I think that has a lot of ramifications, but more kind of long-term ramifications for things like defense spending and who's going to get the money and things like that. Which, speaking of, came out yesterday that Germany's doing a bunch of new defense spending, and I think it was only like 8% of it was allocated to U.S. defense manufacturers, which normally they're doing, I don't know, 30 to 50%, I think, something like that, goes to the U.S. So they definitely made a statement with where they're putting their money, that they want to buy uh, domestic European produced stuff, not, much less so American stuff. And I think that's going to be a trend globally, where people want to buy non-American defense things more than they used to. At least diversify their suppliers for defense. Um, so to me, like the just rest of world non-U.S. defense companies are going to do really well for the next decade, and just no two ways about it. Probably made just about anywhere. Like I don't care if it's you know Turkey, Pakistan, uh, Sweden, France, whatever. I think all these places are going to do well. Um, the last thing I'll talk about, and I'll let you guys go today, is so I built a chart where I watch a few different things against the S&P. Basically, to me, I refer to them as the three pillars, like things that kind of have to be going well for the equity market to do well. One is liquidity, and that's just Fed liquidity, domestic U.S. liquidity, uh, and that has been going straight down because we're refilling the Treasury General account, and as you have to refill this account, you have to do that by essentially removing money from the rest of the economy. That's why it's a liquidity drain. And the opposite, whenever they let it run down during like a debt ceiling thing, it's like you're adding money into the economy and you don't have to borrow it because you already have it. So it reduces the amount of money that's in the economy essentially for that period of time. That's been happening, for the last couple of months, and market just hasn't really cared. And I think you can argue it kind of still doesn't, although Bitcoin is a very liquidity sensitive thing, and it's starting to tell you maybe liquidity is finally starting to touch the market a little here. But of note too, the other thing I watch is something I built called the pressure index, and that combines the dollar, rates, and oil, because those are three things that can really squeeze the economy. Could squeeze consumption, consumers, businesses. Like cost of capital going up, not good. The currency going up, and not good because it hurts overseas revenues, things like that. It hurts exports in general. And then of course oil. Like oil, every time the dollar or oil goes up, it's just reducing everyone's margins. It's like a margin thief if you think about it that way. It's just every dollar you have to allocate to oil or gas, whatever. This dollar you don't get to allocate to something else. Not really great for productivity. Not great for profit margins. You name it. So when those three things kind of combined start to like pick up, usually the market doesn't love that. Now if it picks up violently, the market really hates it. If it grinds slowly, or if it's coming from a really low base, the markets can deal with that. And right now we are coming from a low base. Like rates are pretty low. The dollar obviously is pretty low. Oil is obviously pretty low. So I don't expect this to like rock markets by any stretch if it keeps picking up, but it's just another headwind. So all three of those things suddenly are headwinds, and the market is starting to curl over a little here, break some trend lines that I talked about. So if those three pillars keep moving against the market, I expect some issues. And then obviously going back to if we flip into negative gamma, and then you get all the systematic folks selling, then you can finally kind of get that 5 to 15% kind of just drawdown for no other reason than the mechanics. So that's kind of front and center for me on my radar. The rest of this week, especially, and into next week. It obviously can go either way, but I think it would be crazy to be just 100% super invested, super long, especially in things that have gone straight up lately, given this backdrop of potential issue. And it doesn't matter how sexy an investment is, you get a liquidity air pocket and a liquidity event, forced selling from the people that own it. Like it doesn't matter what it is, it can go down a lot quickly. So that includes some of our favorite stuff, like we talked about with gold miners, Chinese equities, just global equities. Like dollar keeps ripping, and you get just a risk off week or two. Everything can go down. These uranium miners that we like, some of the oil stuff that suddenly has peaked, peaked its head above and started to do a little bit better. Like the solar stuff I like all this stuff can get hit. So that's why you want to have cash and hedges so that you can buy into the dips of the stuff you really, really like, and believe in kind of medium term. But that's all from me. Don't forget you can download and subscribe at knowyourriskpodcast.com. We'll be back with one more episode to wrap up the week tomorrow. And then remember, for the housekeeping, I'll probably be around next Monday, and then maybe, and then I'll be out for a couple weeks. But we'll be back with more tomorrow. Check us out on YouTube, and yeah, cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.